The holidays means Christmas movie classics like Elf.
Ah! Oh my God!
Die Hard, yes, a Christmas movie.
Yippee-ki-yay, mother... Watch your language.
How the Grinch Stole Christmas.
I Stole Your Christmas.
No, not that one.
I'm the Grinch that stole Christmas.
Closer, but nah.
Got a wonderful, awful idea.
Yeah. And of course, It's a Wonderful Life.
Teacher says every time a bell rings, an angel gets his wings.
That's right, Zuzu.
Pedals.
Our question for today is, what can It's a Wonderful Life teach us about the modern banking system?
That sounds boring.
So if you watch this video, you'll learn what fractional reserve banking is and how events in It's a Wonderful Life very much mirror what happened to a bank earlier this year.
Sure I care anymore.
Okay, so a little about It's a Wonderful Life. It came out in 1946.
Long time ago.
So 2 years after the end of World War II. And it stars Jimmy Stewart as George Bailey. And George Bailey runs a local community bank, which at this time, this type of bank would have been called a building and loan.
No, that's my business, building and loan.
Or a saving and loan, which is the exact same thing.
Oh, it's the same.
Now, you have to excuse me, because of copyright laws, I can only show very short clips of the movie.
Lame.
So, forgive me, but you'll get the picture. I'll narrate in between, and let's get into it. Here we go.
Don't look now, but there's something funny going on over there at the bank, George.
Okay, time out. Let me set the scene real quick. George Bailey just got married to his new wife, Mary, and they are driving home from the wedding, and they pass by the Bailey saving and loan. Okay.
Hey, Ernie, you got any money in the bank? You better hurry. I've never really seen one, but that's got all the earmarks of being a run.
Okay, so notice the driver just said it's got all the earmarks of a run on a bank. So we'll get back to that in a bit, but just keep that in mind.
What happened? How did it start?
Well, how does a thing like this ever start? All I know is the bank called our loan.
They did what?
When? About an hour ago, I handed over all our cash. All of it. Every cent of it, and still was less than we owed them.
Holy mackerel!
Now, as you just heard, Bailey's partner gave the collector from that bank all the cash they had on hand. So now they don't have any money if someone wanted to make a withdrawal. If you know the movie, there's another character named Mr. Potter.
Mr. Potter.
Who's about to step in and help.
I'm from the government, and I'm here to help.
Let's keep watching.
I'm going all out to help in this crisis. I have just guaranteed the bank sufficient funds to meet their needs. They will close up for a week and then reopen.
Just took over the bank.
Okay, so Mr. Potter
will
help everyone get through this, but it's going to cost them. And there will be money soon, but people are freaking out because they need money now. You got to remember, this is long before credit or debit cards. So if you wanted to buy something like groceries, you needed cash.
In the money game, cash is king.
So Bailey doesn't want his savings and loan to be taken over by Mr. Potter.
Mr. Potter.
So he's going to try and calm everyone down. Watch.
Let's come on in. Now, just remember that this thing isn't as black as it appears.
So he needs to convince everyone not to try and withdraw all of their money from the bank. Because if they do, he's either going to have to shut down the bank or let Mr. Potter take over the bank, which would put Mr. Potter in a position to take advantage of everyone. This next part is the really important part. Listen to what George Bailey says about where their money is. Listen to this.
Ask him. We don't need Potter over here.
And I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
There's nothing in there.
Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others.
That's an important moment. Bailey essentially just explained what fractional reserve banking is. So to really understand what's going on in this scene, you need to know what fractional reserve banking is.
I don't care anymore.
What is fractional reserve banking? So fractional reserve banking is a system in which only a fraction of bank deposits are required to be kept by the bank and available for withdrawal at any given time. Banks only need to keep a small percentage of their customers' deposits on hand, and they actually use that cash that their customers deposit into their accounts to give out loans to other customers. Now, this may sound kind of crazy if this is the first time you've ever heard about this, but this is how pretty much all banking works. So what's the benefit of this? Why are banks even allowed to do this? Well, first of all, you sign an agreement with your bank where you allow them to do this when you open an account.
What?
Fractional reserves works to expand the economy by freeing capital for lending. Capital is funds that are available, essentially. So today, most economies' financial systems use fractional reserve banking. So if you have money in a bank, I promise you they are using fractional reserve banking.
Are you sure?
One recent list I found of countries that do not use fractional reserve banking is very interesting. It includes the following countries: Libya, Iran, Iraq, North Korea,
Hate us because they ain't us.
Afghanistan, and Cuba. So if you hate the idea of fractional reserve banking and want to move to a country that doesn't use fractional reserve banking, those are your options.
I changed my mind.
Back to the story. And remember, Mr. Potter
has
already agreed to give the bank enough money to reinstate the loan with the Bailey's saving and loan, but that's not till next week, and everyone needs money now. So, let's see what happens.
What's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not, that's why.
Okay, now this is actually such an interesting point that George Bailey just made. So much of how the economy and markets work is not so much data and math, but human behavior. Panic selling, herd mentality that causes market bubbles and crashes, even consumer confidence and spending play a significant role in driving consumer behavior. So that's another video, so we'll get back to the story, but maybe more on that some other time.
He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together.
We just gotta stick together.
So we've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money. How am I going to live until the bank opens?
Okay, quick aside. George and Mary, like I said, were just driving home from getting married, so they have a bunch of cash on hand that they got from their wedding. So watch what happens.
Faith,
How much do you need?
Hey! I got $2,000.
Okay, now, you remember the term that the driver used at the beginning of this scene?
That's got all the earmarks of being a run.
Keep that in mind. Watch what the first customer does.
Hey, Tom, how much do you need?
$242.
No, Tom, just enough to tide you over into the bank.
I'll take $242.
This is what panic looks like.
This is the perfect time to panic.
And this is exactly the type of behavior that causes a run or a run on the bank. So he wanted his
$242.
And if everyone did that, if everyone took out all of the money that they had in the bank, then only the first few customers would be able to get to withdraw their money before the bank would have to shut down. And the bank would be seized, and then the rest of the people who had their money in the bank would lose all of their money. Now, that's not exactly what happens today, and so I'll explain that, but let's keep watching.
Well, what'll it take until the bank opens? What do you need?
Well, I suppose $20.
$20. Now you're talking.
That is well-placed trust.
You trust me?
I trust you.
They know that George Bailey is a good man and that they can trust him. And this is something we've largely lost as a society, and probably for good reason, but it's a tragedy nonetheless.
Tragedy.
Let's see what the next customer does.
Could I have $17.50?
Bless your heart, of course you can have it. You got 50 cents.
So the rest of the customers trust George Bailey enough to only take what they need, and at the end of the scene, they end up with $2 left.
2, 1, bingo! We made it! Close the door, Eustace! We made it! Look, we're still in business. We still got $2 left.
So they were able to prevent the run on the bank from exhausting all of their cash. so they could stay in business.
A toast to Mama Dollar and to Papa Dollar, and if you want to keep this old building alone in business, you better have a family real quick.
George Bailey was able to avoid his bank from failing by using his own money to provide the cash needed for his customers' withdrawals. So you may be asking yourself, if a run on the bank is possible with fractional reserve banking, I know we kind of touched on this, but why is fractional reserve banking even a thing? Well, the reality is that it's just not feasible for banks to have to do 100% reserve banking, where they would need to keep significant amounts of capital to cover not only to ensure deposits from customers, but also in order to issue loans. They would need crazy amounts of capital. This is like the concept of the gold standard. Ultimately, if countries and banks did not use fractional reserve banking, then this would greatly reduce growth.
I was in the pool!
In developed and developing countries and economies, because the banks couldn't issue debt to businesses or consumers who needed large loans for purchases and investments.
Now you know.
Now that you know what fractional reserve banking is, and a run on the bank,
We are smart.
what does this have to do with today? Well, earlier this year, there was a run on a bank.
No way.
You may have heard about Silicon Valley Bank in the news. Why the run on the bank started is pretty complicated and not the same reason that we saw for Bailey's saving and loan, but suffice to say, everyone was trying to get their money out of the bank. Now, important to note that there's a special rule where the government does insure funds in a bank up to $250,000 for businesses and for consumers, for individuals. So if you're an individual and you have $50,000 at Wells Fargo and Wells Fargo goes under, then the government's going to insure your money. But if you're a business, for example, and you have $250 million in the bank, in Silicon Valley Bank, for example, and the bank goes under, the federal government is only required to insure $250,000. So that's 1%. You would lose 99% of the money that you had in the bank. Now, in the case of Silicon Valley Bank, Uncle Joe stepped in, and more specifically the Fed, actually, and they seized the bank and forced a merger with a more stable bank. And more importantly, they insured every penny of deposits for customers and businesses that had money at Silicon Valley Bank. I actually know a couple of businesses that had money at Silicon Valley Bank. You can bet that was a very, very stressful moment for them. The possibility of losing millions of dollars, pretty mind-boggling. But all this to say, does this sound like a free market to you? Ever heard the expression, too big to fail? That expression, that may be a litmus test to see if you're a millennial or older or not, but nevertheless. Let me know what you think about this. Is this information interesting, helpful, maybe? And more importantly, have you seen It's a Wonderful Life? I realized that my wife had not seen It's a Wonderful Life, so she watched it for the first time a couple of weeks ago. Hey, what's your favorite Christmas movie? Let me know in the comments. I appreciate you guys hanging out, and I hope y'all all have a very Merry Christmas. God bless.